The crypto curator, back with Bitcoin and politics. And I've got a lot to cover on both the legislative side and the regulatory side. But before I get to that, let me say thanks to our sponsor, RoundlyX. Hey, go over to roundlyx.com, attach your debit card, credit card to their platform. You're going to stack sats without even thinking about it, which is amazing. And if you use the code Bitcoin Politics, you're going to get $4 in Bitcoin. So with that, let's get on with the show. All right, folks, we are back once again Thursday. This is Bitcoin and Politics. Check out my website, cryptocurrencies.com. That's where you're going to find all the content. But I'm going to jump right into this because I do have a lot of content to cover. There's a lot that happened this week, and I'm just doing sort of a recap of the weekend. So I'm starting off with the legislation first. At the federal level for legislation, we had some very interesting things happen. Senator Tom Tillis, he's a Republican in North Carolina, he came out and he's sponsoring a bill that would require digital asset exchanges and custodians operating in the U.S. to provide an independently verified proof of reserves of their assets. Now, listen, I haven't been a big fan of this whole proof of reserve things because what does it really prove? I mean, it could be something, but it just depends on how they're handling their reserves. But if this bill goes through, this is going to have them to independently verify the proof of reserve, which could probably make it better for these exchanges. In addition to that, on the Democratic side, we have Elizabeth Warren, who I know everyone knows she just loves Bitcoin, right? Not. She's pledging to reintroduce a bill to tighten anti-money laundering rules for crypto firms. Now, I got that news information from the blog. So if you guys have access to this, you can click on that little link and you can read more about that at the blog. Now, in addition to that, we also have probably the biggest story that came out yesterday was Representative Tom Emmer, who we know is a huge supporter of digital assets. He's come out with HR 1122, and you can find this at caphillcrypto.com. There's a legislative tracker, and that's what that links to. And it's called the CBDC Anti-Surveillance State Act. Listen, if anybody's in tune with what's going on with CBDCs, it's Representative Emmer. And he is going to make sure that we're not going to get bamboozled here in the US like some of these other countries are doing with their CBDCs. So this is introducing a new bill that's seeking to block the Federal Reserve, which we all know is neither federal nor a reserve. It's a private company, from issuing a central bank digital currency, a CBDC. The bill is going to protect U.S. citizens' financial privacy. And this is the issue that we have with CBDCs, right? It's because depending on how the government issue them, you lose all privacy to your transactions, you lose all privacy about what you're doing with this particular type of a currency. And so this article is mentioned in Finbold, Bitconnects, Cointelegraph, NewsBTC, and BitB and Crypto. As you can see, it got a lot of coverage, right? And that was just since yesterday. I'm sure some other publications will pick up that story as well. So that's what you need to know from that. Now, let me give you a quote from Representative Emmer, and this is what he said. He said, any digital version of the dollar must uphold our American values of privacy, individual sovereignty, and free market competitiveness. Anything less opens the door to the development of a dangerous surveillance tool. Now, and he's the GOP's majority whip. Now, if you know, me and our producer, Nick, we've talked about this ad nauseum, right, about the dangers of CBDCs. And again, while a lot of people in crypto are not fans of the government, this you can get behind, right? Because you do want Representative Emmer to be successful at putting this bill into Congress and it getting bipartisan support and hopefully making it to the desk of the president. Therefore, we are not like other countries and we're going to be surveilling our people. Now, our good friend, John Creasy said that Emmer's quote is so encouraging. I have to agree with you, John. It is incredibly encouraging because that means that we're not going to be like everybody else, right? Which is great. Okay, let's go on. There's some other stuff that was also happening up on Capitol Hill, and of course, not from some of our fans again. This time is Representative Maxine Waters. Now, we know Maxine Waters. She's Democrat, California's 43rd district. She says that the crypto market crash and bankruptcies gave U.S. lawmakers an opportunity of getting accountability in the space through legislation. If I'm not mistaken, I believe it was Maxine Waters who was taking pictures with our good friend Sam Bankman-Fried. I think Sam Bankman-Fried probably gave her money for her reelection campaign. I don't know all that for a fact, but the point is this: these lawmakers that are coming out trying to talk about getting accountability in this space, there's a lot of accountability that should have been done back when Sam Bankman-Fried, back when Do Kwon, back with all these other, Alex Mashinsky, right? Here's the thing, folks. When we're looking at what's happening up on Capitol Hill, the hope is that those folks are going to put in legislation that is friendly toward Bitcoin primarily and some of the other digital assets. But we need to do this thing right. And if we get it right, we're going to not only protect investors here at home, we're also going to make sure we stay the leader in this space. Now, this is what she says. She says, to the CFTC and to the SEC, I am not going to get in between any disagreement, any dislike, any of the approaches. The two of you had better come together so that we can deal with crypto. And that's what she says. She says, I think it's time for the Treasury, the Feds, the CFTC, the SEC, all of us better get together on crypto. Listen, I'm not going to deny what she said is true. I think it would be great if everyone would put their egos aside, all of these regulatory agencies, come together and work in a comprehensive fashion to create some really good regulation legislation for this space. It makes no sense for us to be at war with each other, trying to see who's going to be top dog at regulating this industry. Why not be collaborative? And that's something that a lot of folks, it sort of skips them. Okay, let's move on from the federal to the state. There was some interesting stuff that happened in the state this week. The first was Wyoming, but we're going to get to that after I talk about Illinois, is Illinois Senate Bill 1887. On the surface, it might look like, but underneath, there's some trouble. The Digital Property Protection and Law Enforcement Act in the state includes digital transactions and the execution of smart contracts. Now, it was Drew Hinkes who said Illinois Senate Bill SB 1887 would drive out blockchain node operators, miners, and validators, waste judicial resources, and confuse existing law in the Quinnick's attempts to protect Illinois consumers. Let's examine the mess in a thread. And so I linked his tweet thread there for you to take a look at. But here's what he's saying. He's saying this really isn't that great of a bill. For the consumer protection, he says he can agree with that. But the way they're doing it, he totally disagrees with, right? And so one of the things we have to be careful of when these states are starting to try to implement controls to digital assets is that they do it in a way that's done in a sensible fashion, trying to make it hard for blockchain nodes, validators, the people that miners that are operating in the space doesn't make any sense. And by that, meaning making them jump through all of these hoops and loops to try to be in line with regulation, it doesn't make sense. And so while what they're trying to do is good, they're missing the mark. Now, on the opposite side of that, Wyoming is actually doing it right. Why? Because Wyoming is saying we're going to protect it so that you don't have to, and I don't have a slide for that one, but Wyoming is saying you shouldn't be able to force someone to give you their keys or to reveal their keys and wallets to you. And that's a good thing. And that came out previous week. This Illinois is coming out this week. So let's move on to New York. So if we look at New York says, and this is the New York Department of Financial Services, NYDFS, they said the new enhancements will provide the department with additional capabilities to detect potential insider trading, market manipulation, and front-running activities associated with the department regulated entities and applications. Exposure or potential exposure to listed virtual currency wallet addresses. Here's what we have to remember. As much as we don't like legislation in this space, we do need some, and for some of these reasons. Again, as Hinkie said, how you do it is very important. And so how New York is doing this is going to be the devil in the details, right? But I don't think anybody would argue with, detecting insider trading or market manipulation or front running activities. I think that's all good things to ultimately protect investors. And the crypto space has been used to running and working in the wild, wild west. And we have to realize, listen, folks, I know that no one's going to be a fan of this. The traditional financial market has a lot of regulation to it. The digital asset market, crypto asset market, is going to also have to come and play with the same type of regulation. A lot of this regulation already exists, and it's already there for this space. It's just that it's being ignored or it's not being adhered to. And so I believe that sensible regulation, where it makes sense, should be implemented to protect us from all the mayhem that's out there, State Farm and mayhem. If you look at it's actually Allstate, all the mayhem that's out there, I think it's important for this space to have some guidelines in place. And you're going to see this later as Jesse Powell talks about this. I think that it would be beneficial. Okay, let's move from legislation to regulation, right? And when we look at legislation, is anything dealing with policymakers over Capitol Hill. Regulation is dealing with those 3 and 4 letter agencies out there trying to regulate this space. So let's get started with the SEC, the Securities and Exchange Commission. Their chairman, Gary Gensler, came out and he thinks that cryptocurrency industry is playing a game with his agency. He has said that companies are well aware of what they have to do to operate legally within the US, but they decide not to do it. Some of them in open scorn to the regulator. Now, Gary says this, but it's sort of tongue in cheek because the reality is it's not a simple thing to be able to come in line with what the regulators want. They try to make it sound simple. And this is what Jesse Powell was saying, like, oh, what do you mean? I just paid you $30 million when all I had to do was go to a website and fill out a form. Oh, how crazy of me, right? It's not that easy, and it's not that clear cut either. And so I think Gary is being a little disingenuous with the way that he mentions that and he talks about it. Now, as we look at the SEC too, Dennis Keller, he is the CEO of Better Markets. Now, this is a Washington, D.C. group that pushes for tougher financial protection. Listen to what he had to say. He said the SEC has been consistently applying long-standing, well-known, and clear security laws to crypto activities. Not the Howey test doesn't match with crypto. The fundamental problem is that the crypto industry has intentionally chosen not to comply with those security laws. And I disagree. Listen, I don't think that these companies are intentionally trying not to do this. They just need clear guidance on what it is they need to do. If you can remember back, I believe it was Coinbase who went to the SEC and said, hey, tell us what we have to do. They got no clear guidance from the SEC on what they needed to do. So this is what we have to keep in mind, is that the SEC, they are playing a little bit of a game themselves. They might say the crypto industry is playing games with them, but no, I think they're playing games too. Again, when I get to Jesse Powell's comments, we're going to see why that is. Now, there's another article came out in the block, and it was talking about the SEC as well. And this was from Hester Pierce, and she's one of the dissenting members of the SEC. And this is some of the things that was being pointed out in this article, that the SEC struggles to find out how to productively regulate crypto. And that's been the problem. How do we productively regulate this space? Attempting to plant its regulatory flag following a rush of enforcement actions brought charges against Terraform Labs and its CEO, Do Kwon, over its collapsed algorithm stablecoin Terra USD, and charged and settled with NBA Hall of Famer Paul Pierce for unlawfully touting a token. So as you can see, the SEC has been getting busy this year. We're just in the second month, and they have been going like crazy on the space, right? And so there was another article came out talking about Hester Pierce and sort of her views and what's coming up. So she's, again, like I said, she's a Republican commissioner, and she's the dissenting voice that's with the SEC. This is what she said. One of the problems that you have is that all of these trading platforms are likely to have on them assets that no one thinks are securities. And this is the sticking point to this whole issue. What's a security? Most people are still debating what that is. Bitcoin has been proven not to be a security, it's a commodity. Litecoin is a commodity. Ethereum, it's been said it's a commodity. Some people still think it's a security. And then they keep changing the rules of like, well, at the beginning it might have been a security, but now it's not a security anymore. Where do we stand with what is and what isn't a security? This is part of the problems. She goes on and says, and we're not used to having platforms that trade securities alongside non-securities. That's going to be an issue that we have to resolve. Okay, so we got the dissenting voice in the SEC. We got the SEC coming out talking about that the crypto industry playing games with them. Well, as I said before, Jesse Powell, CEO of Kraken, those guys got fined by the SEC and they had to pay $30 million. Here's my question to everybody. Where does that 30 million go to? Why does the fines have to be so high? And what is it really paying for? I think it's basically pay to play. If you want to play in this space, you're going to pay the SEC their money. Well, Jesse Powell came out, and this is, according to Jesse Powell, US regulators allow bad actors in the crypto space to suck up users, revenue, and venture capital could effectively destroy the good guys. It serves their agenda. And so what Jesse Powell is saying is, listen, SEC knows what they're doing. They're allowing these bad actors to run rampant, hoping that they cause all this destruction, later to come in, act like the good guy, fine everybody, shut everybody down. Well, that was the game plan from the very beginning. Powell's statement followed Kraken reaching an agreement with the SEC. So this came as a result of his agreement with the SEC, in which the crypto firm agreed to stop offering staking services or programs to US clients and to pay the $30 million in disgorgement, prejudgment, interest, and civil penalties. Many in the crypto space have criticized the SEC's actions as another example of regulation by enforcement. And Hester Pierce has been against this, a criticism extended to the regulator cracking down on celebrities endorsing tokens through social media channels. The SEC was around when listen, last year, Super Bowl, all these ads, all these celebrities, the SEC was well aware of this. At any point, the SEC could have stepped in and told all these people, time out. It was not a shock that this was going to happen because it was talked about in advance. You can't just one day go on TV and start promoting things. There's a lot of conversation that had to be had. Can't tell me the SEC didn't know about this stuff. They should have did something then before it went rampant, and they could have shut it down and not caused so much damage. Jesse Powell goes on and says, I can't tell you how infuriating it is to have pointed out massive red flags and obviously illegal activity to regulators only to have them ignore the issue for years. They're offshore. It's complicated. We're looking at everybody for years, then to be used as their example. And Jesse Powell has a right to feel this way. Listen, why would they allow all FTX, Do Kwon, Alex Mashinsky, right? They had all these people, BlockFi, Voyager, right? Now these guys are being made an example of, and it's just unfair. Well, CZ came out with the response to Jesse Powell's statement, and this is what he said. He said the term offshore appears overly narrow-minded, self-centered, misses the broader picture, and is unhelpful to the development of our industry. Taking an onshore perspective, the issue discussed, FTX US, is an onshore exchange. SBF and FTX key execs are Americans. They spent a considerable amount of time, their time and effort lobbying in the US. This did not stop fraud from being committed. Drawing a distinction between onshore and everybody else is self-centered and somewhat arrogant. Everyone is onshore from their own perspective. We are better than everyone else is not a panacea toward building a better industry. Listen, again, tit for tat, right? I was talking to Matthew Deemer, and we were talking about who's really benefiting from all of this finger pointing and sort of tattletelling on everybody else, right? Because we know Coinbase came out and they were like, hey, you need to go take a look at these guys over here. And I'm going to get to some of that news in a minute. And everyone's pointing fingers and everyone's sort of telling on everybody else. It's just as bad as the incestuous relationship that we had with Celsius and BlockFi and 3 Hours Capital and FTX. And it's just nuts, right? And this is, again, the wild, wild west of crypto that at some point needs to evolve, innovate its way out of this crazy nonsense. Now, another issue that came up this week was about Paxos, right? Paxos is a platform that was minting BUSD. And again, I was telling you about Coinbase. Coinbase went and said, hey, take a look at these guys over here. Their thing is not right, right? And so all of a sudden, they get looked at, and voila, we have what we have. So let me read through this. So Paxos Trust Company is reportedly engaging in a constructive discussions with the Securities and Exchange Commission. The firm's CEO, Charles Casarilla, stated in an email that they're ready to defend BUSD's non-security status through litigation. It's a stable coin. How in the world can it be a security? The NYDFS, the big dogs, they're the big watchdogs, had ordered Paxos to stop issuing BUSD earlier this month, and the SEC previously issued a Wales notice to the BUSD issuer indicating potential legal action that might be initiated. This was covered in Ethereum Web Network and also CoinDesk. So Paxos, as a result of that issue coming up, they have stopped now issuing BUSD, right? And this is on the next slide. The firm stated that it would continue supporting and redeeming the token until February of 2024. And this is what Casarilla said. We remain fully focused on serving the end holders of BUSD and protecting them from undue harm. Paxos will continue to support BUSD through at least February 2024 and maintain the highest standards of security and soundness in the stablecoin market. He went on to say that they're going to talk offline with the SEC and they're going to figure this whole thing out. He goes on and says in another quote, the market has evolved and Binance relationship is no longer aligned with our current strategic priorities. So they said this was not in conjunction with this whole SEC thing, but that they were terminating their relationship with Binance. You know, it's interesting that it came up around that time. If we look at the next slide, the New York Department of Financial Services investigation against Paxos may have stemmed from a report from Circle, which reportedly sent a complaint to the state regulator regarding Binance's reserves. So I had that incorrect. It wasn't actually Coinbase, it was Circle, not Coinbase. Correction. So yeah, it was Circle that sort of pointed the finger at them and said, hey, take a look at these guys. They might have something going on over there. The point to all of this is, again, rather it's stable coins, rather it's the exchanges, rather it's securities and non-securities, this space is incredibly robust, has a lot of different angles to it, and you're not going to find one size fits all. The Howey test is not going to do it. Some of the existing regulation is not going to do it. This space really should have its own governing body to overlook and oversee it. The traditional doesn't work, and that's just from my view. Now, a lot of people say, as the gentleman said earlier, that's not true, that what we have existing are, but you can see there's too many problems in this space. There's too much new innovation, too much new tech that they need to address that doesn't get addressed with traditional finance. So let's take a look internationally now, because there was some international news that came out. We start off with the SEC of Hong Kong, basically the Securities and Futures Commission is what they call it. Newly proposed licensing regime for cryptocurrency exchange set to take effect from June 2023, lifting a ban from retail investors. Now, I did reach out to CoinDesk and the block, and apparently it's actually June 2024, not June 2023. So that was an oversight on my part. I should have corrected that one. But let me go on. So what this is talking about is that in Hong Kong, which is part of China, they're starting to lift the ban on retail trading of digital assets, which is a good thing. And so this is in response to that. They talk about a key consideration of the public consultation, because what they've done, they reached out to the public and said, we want to open this up to get comments from the public to talk about what we are now trying to propose as far as regulation. And they're given a window to do that. And again, it's to June 2024, not June 2023, as to whether they allow licensed exchanges to serve retail investors in the country and what measure should be implemented to provide a range of robust investor protection measures. The SFCs, this is the Securities Futures Commission, proposed regulatory guidelines are based on existing requirements for licensed security brokers and automated trading venues, while modifications have been made for some to some of the existing prerequisites. And so again, there currently already is some regulatory guidelines, but they're going to be modifying those guidelines for some of the other exchanges that are coming up in Hong Kong. Now, part of this can be because they're trying to bring on new talent and new money into Hong Kong, right? And that could be one of the reasons why. This is from Julia Leong, the SFC CEO. As has been our philosophy since 2018, our proposed requirements for virtual asset trading platforms include robust measures to protect investors. We all love that when they say protect investors, hint, hint. Following the same business, same risk, same rules principle. And so, again, they're saying, hey, listen, we have rules and regulations in place. We just need people to adhere to them. But when it comes to virtual assets or crypto assets, I still think that things need to be done a little differently. So as we go ahead and look at another part that the SFC in Hong Kong was talking about, this new sort of regulation and guidelines, under proposed measures, it will be up to operators to do due diligence on tokens and monitor them. Part of the problem with regulations is the expense involved with these exchanges. It requires a lot of money to do your due diligence on these tokens and then to monitor them on an ongoing basis. That includes assessing the regulatory status of the asset in each jurisdiction in which the operator provides trading services. It also proposes checks on the operator's liquidity and whether its holdings are concentrated or controlled by a small number of individual entities. Regulation can be incredibly tough. Now, with this regulation, there is some belief that if you read the fine print, and this is on the next slide, if you read the fine print of its crypto regulation proposals, reveals a lot of restrictions and hidden catches. Any asset that's listed will need a background check on the issuers and developers. They don't tell you that up front, but if you look deep in there, that's what they're saying. You got to do a background check on the issuers and developers. There's also needs to be checks on the supply, demand, and liquidity of the tokens listed. Technical aspects of the blockchain, marketing materials, utilities, and legal risk will all come under heavy scrutiny. A lot of work, right? And the smaller exchanges cannot shoulder that type of weight when it comes to the regulatory pressure. This is why I believe if these laws and these rules get put into place, it is going to wash out a whole bunch of folks who don't really have the ability to really amp their standards up and come out and meet these requirements. This means just like we have all of these exchanges, it's going to wash a lot of them out, and you'll have a handful of key exchanges in which you can trade crypto assets on them, which is what I think we're headed toward. Now, one of the things that we have to realize is that our good friends China, which Hong Kong is part of China, they seem to be doing okay with this. They're not against Hong Kong lifting the ban, allowing more trading coming in. But didn't we say that China banned crypto and banned Bitcoin? Not true. Don't listen to what they say. Watch what they do, because this is the way it works. They will talk out of one side of their mouth and they'll do something else with their other hand on the other side. So they're not against Hong Kong's aspiration to become a crypto hub. This is in contradiction to Beijing's stance on the matters regarding digital currencies on the mainland. Now, in addition to the exchange portion and them lifting the requirements for people to trade, stablecoins came into play this week as well. The Hong Kong Monetary Authority, HKMA, don't you love all the 3- and 4-letter agencies? They indicated it may require firms to keep their principal business and have a locally incorporated entity in Hong Kong if they want to obtain stablecoin licenses. The HKMA's current position would mean that exchanges would have to segregate their virtual asset business from their stablecoin business. This would cause a lot of problems because here's the thing, folks. We use digital assets, stablecoins, to trade digital assets. And if you have to have them separated, what do you have to do? Convert this from stablecoins to something else and then go over and buy the asset? This is the problem that we had with fiat in the first place. You need them together. And so by them saying they're going to separate them will cause problems, I believe. As we move on from Hong Kong to Canada, the Canadian Securities Administration, CSA, like our SEC, published a notice on February 22nd describing new comments it expects from crypto asset trading platforms seeking registration in Canada. So if you're starting to see this theme happen, you're dealing with all of these exchanges or these trading platforms having to report to the SEC, basically, all the global SECs, right? What this does, again, is bring all of this under their control and purview so they can have visibility as to what's going on with crypto asset trading. This is where the future's headed. Eventually, I believe we're going to see every crypto trading activity being monitored by governmental agencies. That's just the way that it is. It's hard to get away from it because as long as you got bad actors out there like FTX and Sam Bankman-Fried and Do Kwon and Alex Mashinsky and all the other bad actors, you're going to need somebody in place to look over this space. I personally think it would have been better if we'd had, they call them self-regulatory organizations, SROs. Crypto should have done this themselves, stood up their own organization, said, hey, we will govern ourselves, and that's a way to keep the government completely out of this. And then we could send those reports to government agencies if they want to, but we should be responsible for regulating our own space. That would have been great. In Canada, they go on and say that the CTPs will enter into a new version of pre-registration undertakings, PRUs, which are legally binding documents. Registered CTPs will be contacted by their principal regulator about compliance with the new expectations. And then if we go on, there's one last part that I do want to talk about with Canada's Securities Administration, and that is the authorities have strengthened their oversight of crypto trading platforms. Crypto trading platforms pursuing registration will have to undergo enhanced pre-registration within 30 days, and Canada recently ordered that crypto trading platforms not offer or allow deposits of stablecoins. Stablecoins, trading platforms, they are getting the brunt of this regulatory pressure right now. And why? Because stablecoins really can compete with fiat, right? And these exchanges are competing with the traditional trading environment. And so what you're starting to see now is if you can bring in the stable coins and you can bring in the exchanges, you, for the most part, have really began to put your arms around the crypto world, because outside of that, what else do you have? DeFi, decentralized exchanges. That's right. That means people either have to go regulated or they can go decentralized. It's hard to regulate the decentralized exchanges because there's no one to go after, right? Especially if they're truly decentralized. But we're starting to find things that are saying they're decentralized are not really decentralized. There's only one decentralized asset on the planet, and that's Bitcoin. Bitcoin is where it's at. And that's why the Bitcoin maxis are so adamant about everybody going to Bitcoin, because you take the power out of the regulator's hands when you're dealing with Bitcoin. If you note, through all of this that I just discussed, not once did Bitcoin get mentioned. It was all about crypto. And crypto, altcoins, shitcoins we call them, that's what needs the regulatory pressure, and that's what's going to fill that. Bitcoin is in a class of its own. It still sits there by itself. You can buy Bitcoin, hold Bitcoin, you can do whatever you need to do with Bitcoin. And for the most part, it's a commodity, right? We know that Bitcoin is legal tender in El Salvador. We know that the IMF have come out this week and said that people shouldn't be using crypto as legal tender. Too late. El Salvador is doing it already, and we've got more countries coming after that. So that's been my scoop on all the things that's sort of been happening regulatory wise for the most part. There are a few things that I left out, didn't cover, weren't that big of a deal, didn't get that much coverage in the media. But this is what you guys need to realize and stay focused on, is that, again, when you look at two different sides, legislators, this is where we can have our voice with our representatives and talk with them. And then the regulators. These legislators are telling the regulators what they need to do and what they need to put into place. They're the ones that create the laws that they're responsible for upholding. Hopefully you'll understand that. Now, if you want to stay up on everything, please go over to Cap Hill Crypto and you can check out the legislative tracker there. George Leonardo has done a phenomenal job at creating a platform to help you know who's sponsoring what. And it's my hope that you will visit Capitol Crypto. Also get his newsletter. It's amazing. He breaks it all down, tells you what's going on Capitol Hill. When it comes to my website, again, folks, as you can see on the screen, thecryptocurator.com, you'll have the 3 most talked about issues. And as you can see, Binance issue right there today with Forsage. When it comes to these hacks and tax and scams, they're getting shut down. And then Circle having USD, they're doing hiring, which is crazy. Circle is hiring like crazy. You get a video, you get a podcast of the day, you get my shows, and then you get the whole brief and everything. Just make sure you go to thecryptocurator.com. That's where you'll get everything. And make sure you go to roundlyx.com. Make sure you're stacking sats without even knowing it. Folks, this is Paul McNeil for Bitcoin and Politics today. I hope you guys have a really good weekend. And please, can we get above $25,000 next week? Go buy some Bitcoin. Thanks, guys.